The problem from this video can be downloaded at accountingworkbook.com. If you go to the website, click the PDF link and you can download a copy of this and all of my problems for yourself. Now, if you check the website and you click on videos, you'll see there are more videos than those I've listed publicly on YouTube. You can see that there's every problem covered in the workbook has either a public video or a members only video. If you'd like access to the members only video, just click the join button beneath the video player on YouTube. All right, let's jump into the problem. Let's take a look at problem 12.3a. This problem has us doing ratios. We've already learned a few ratios if you've gone through all the videos of this class. This will add a few more and it'll review some of the ones that we already looked at. So this is a very typical position to be in. You are a potential investor, you are an outsider to a company, and you are looking at a set of financial statements thinking, I don't know what to make of this, right? Like, there's a big long list of numbers. They're usually comparative numbers given, and you're just left to ponder, is this good news or bad news? And as mentioned, a lot of times you'll go to an annual general meeting and some accountant will tell you what to think, but it's useful to know what you think yourself. And so this series of videos is going to help to give you the tools to do that. So we've got our set of financial statements, some additional information, and it says for 2023 and 2024, this is required. Compute all common financial ratios from the beginning of this module. If you just go into your accounting workbook and flip to the beginning of the module, you'll see this page, common financial ratios, and we're just going to compute all of them. And so this will give you a good feel for, one, computing the ratio, and two, kind of deriving some meaning from it all. Like, what does it mean? So let's begin, and we're going to start. I'm going to just take this in chunks. So we'll do the liquidity ratios first, the current ratio and the acid test ratio. So here we are. And so the current ratio is current assets divided by current liabilities. Our company's current assets are right here. Our company's current liabilities are right here. And we're going to do this for 2 years. We're going to do this for 2023 and 2024. And we're going to determine if 2024 is better or worse than 2023. So let's do this for the current ratio. For 2023, the current assets, so actually we'll do this. We'll order 2024, 2023, and then better or worse. So 2024, we'll start there. The current assets are $775,000. The current liabilities are $387,000. 775 divided by 387. Let's do the math. 775 divided by 387 is 2.003. 2.003. For 2023, our current assets are 503. Our current liabilities are 235. 503 divided by 235, 2.14. Now, these numbers are not percentages. They are not dollar amounts. They're just numbers. And remember what the current ratio says. It's how able is this company to pay its current liabilities. How well covered are the current liabilities? Well, last year it was 2.14 times the current assets as current liabilities. This year, 2.03. We would still consider this to be okay in terms of liquidity because anything above 1.5 is a little bit of a rule of thumb. So we're above that, but no doubt 2024 compared to 2023, we are getting worse. We are getting less liquid. Marginally less liquid, but less liquid nonetheless. Okay, let's do the acid test ratio. This is just another measure of liquidity, and it's stricter. It says, hey, look, when we do our current ratio, we include things like prepaid insurance. Well, prepaid insurance isn't going to help you pay the bills, right? It doesn't help you pay the bills. Inventory, if you're in a crisis time, it's going to be hard to sell your inventory and recover the value of the inventory. That doesn't really help you pay the bills. In fact, you can be in a crunch where you have too much inventory and you don't know what to do with it. You're unable to sell it. So, that can be a problem. So what the asset test ratio says is, let's just take the most current assets, cash, short-term like stock market investments, Microsoft stock that you could liquidate tomorrow, and net current receivables. Accounts receivable is thought of as pretty liquid. Your most liquid assets, and see how well you cover the current liabilities. Here we're looking for a ratio of 0.9 to 1 as kind of a rule of thumb. So current liabilities I've left highlighted. The most liquid current assets, cash and net current receivables, that's these ones. Inventory we won't do, prepaid insurance we won't do, short-term investments we don't have. So there we have it. There we have our numerator and our denominator. So for 2024, it's going to be 150K plus 140K, the cash plus the receivables, all divided by 387. For the year before, it's going to be 53 plus 80. Oops, man, my writing's getting messy. 53K plus 80K, all divided by the current liabilities, which were 235. So let's do the calculation for this year, 2024. 150 plus 140 divided by 387, we end up at 0.749. We're getting a little risky here. 53 plus 80 divided by, sorry, I should hit equals there. 53 plus 80 equals divided by 235. Last year we were at 0.566. 0.566, and comparing the two, no question they're both below 0.9 to 1, that range we're looking for, but no question we are getting better, and actually significantly better as far as that goes. So our current ratio is a little bit worse, our asset test ratio a lot better. So overall, in terms of liquidity, if I were analyzing this company, yes, it's a mixed bag. I would like this if I were an owner or an investor in the company. I would say, oh, this is actually pretty good. Okay, that's it for liquidity ratios. The next batch of ratios we have to do are turnover ratios. Turnover ratios measure efficiency. So we look at two types here: inventory turnover, that's how well you're selling through your inventory, as well as receivables turnover, and that's how effective you are in collecting your debts, right? The people that owe you money, how effective you are in collecting from them. So here we go. I'd like to actually kind of move this over if I could. Cogs divided by average inventory. Let's do, actually I'm going to move all these over. Maybe I can squish them. Let's do that. Squish you, move you over. Yeah, I just want to have more real estate here. I'm realizing I'm going to run out of room here. Squish that and move it over. Okay, let's start with inventory turnover. Cogs divided by average inventory. Okay, so for 2024 and 2023, and is it better or worse? 2024, our cost of goods sold was 1.5 million. 2023, our cost of goods sold was 1.6 million. The average inventory for 2024, we take the inventory, the beginning of 2024 was 350, the end of 2024, and I'll just highlight this line, was 450. We want the average of these two numbers. So 350 and 450, the average, just add them. 350 plus 450 divided by 2. So 350 plus 450 is 800. 800 divided by 2, it's 400K. That's my average inventory. So that'll be my denominator here. 1,600, 1.6 million the year before. The average between 300 and 350 is 325. When I was a beginning student, I would average all three numbers. That is not correct. We take the beginning inventory plus the ending inventory, divide by 2. So 300 plus 350 is 650, divided by 2 is 325. Okay, let's compute our ratios here. Get some numbers. 1,500 divided by 400, 3.75. So I'm selling through my inventory 3.75 times this year. Last year, 1,600 divided by 325, 4.9 times, 4.92. Well, would you rather sell through your inventory 4 times, as we did this year, or 5 times, as we did last year? You want to sell through your inventory more, right? It's a measure of inventory management. We did worse. Last year, we did better. Day sales in inventory measures the same thing, but puts it in more human terms, in my view. You take 365, divide by the inventory turnover. So in this case, it's 365 divided by 3.75. Last time, it would be 365 divided by 4.92. Let's compute those numbers. 365 divided by 3.75 gives us 97.33. This is days. This one I guess we would measure as times, like the number of times you turned over your inventory. This is the number of days it took. 365 divided by 4.92. Last year was 74.2 days. 74.19 days. So what does this mean? It's saying, how many days is it taking me? How many days on average is inventory sitting on the shelf? Last year, 97 days. This year, I did that backwards. This year, 97 days. Last year, 74 days. You want your inventory setting for less time. So this is worse. No question. Our inventory turnover is worse this year compared to last. Let's look at AR turnover. Net sales divided by average net AR. Now, we might not know the net credit sales. As long as we're being consistent here and just using the same number year to year, I think we're all right. So we'll use net sales. That's what we have. Average net AR, we're going to take the average of what's on this second line I've highlighted. Let's do the averages for net AR. The average between 80 and 140, I think, is 110. Let's see, 140 plus 80 equals divided by 2. Yeah, 110. And the average between 80 and 55, this is going to be an awkward number. 80 plus 55 divided by 2 is 67,500. Okay, so we'll take our net credit sales, or our net sales, 3.6 million divided by 110,000. And for the year before, it's going to be 3.9 million. I'll write all the zeros here because I've got the whole 0.5K. 67,500 is my denominator. So let's compute that. 3.6 million divided by 110 grand. What? Oh, I messed this up. 3.6 million divided by 110. I forgot the 3 zeros. That's a more reasonable number. 32.72 times. The year before, 3.9 million divided by 67,500, 57.77 times. So this tells us how many times during the year I collected through my AR. More is better. It means you're collecting more frequently. This year we collected 32 times, last year 57 times. It's better to collect more, so this year we are doing worse. Lots of worses here. The next one, 365 divided by the AR turnover. So 365 divided by AR turnover, which was 32.72. And this one is 365 divided by 57.77. Let's crunch those numbers. 365 divided by 32.72. I get 11.16 days. So that means from the day I make a sale to the day I get paid, on average, it's taking me 11 days. The year before, 365 divided by 57.77. There, from the day I make a sale to the day I get paid, it's 6.32 days. Oops, I think it was probably hiding behind me there. 6.32 days. So what would you rather? Would you rather wait 6 days to get paid or 11 days to get paid? I'd rather wait 6 days to get paid. This is getting worse. So looking at this page, we had sort of said for liquidity, we said, yeah, one's better, one's worse. But overall, the one that's worse is just marginal. The one that's better is a lot better. So we are in a better liquidity position. Overall, in terms of our turnover, in terms of our efficiency here, we're worse, just worse across the board, and it is significant. We're significantly worse in terms of turnover, and that's a measure of efficiency and how well and how efficiently we're being run. Okay, next. Long-term debt paying ability, the debt ratio, total liabilities divided by total assets. Okay, let's highlight what we're looking at here. The total liabilities, the line is right here. The total assets, that line is right here. So for 2024, I'll just do it right in here, 2024 and 2023, our total liabilities is 937. Our total assets 1375. For 2023, our total liabilities 735, and our total assets 1053. We'll compute these numbers. These are stated as percentages. 937 divided by 1375, 68.15%. And the year before, 735 divided by 1053, 69.8%. So, what's happening here? Well, 68% of our assets are covered by liabilities or debt. In the year before, it was 69.8% of our assets being covered by liabilities and debt. This is getting better, right? This is a measure of debt, and we have less debt now. Now, not all companies believe this. Some companies think, no, you should borrow more and make use of that leverage. You can do more if you have more debt. In our class and in an intro class, generally here, smaller is safer, right? Smaller means you have less debt, less risk, and that's considered to be safer, and we'll call that better for our purposes. Again, a more sophisticated read would say just riskier, and riskier is not necessarily worse, but in our class, we're saying safer is better, and 68% is safer than 69%. This is better. A little bit better, not crazy better, but better. Let's do times interest earned again for 2024 and 2023. Income from operations divided by interest expense. This says how readily can we pay our interest bill. So it's our income from operations, which is operating income, divided by interest expense. So 500 divided by 200, 300 divided by 150. Oops, gotta get a pen out here. 500 divided by 200, 2.5, and the year before was 300 divided by 150, and that's 2. So last year I could cover my interest bill twice over, 2 times over. This year, 2.5 times over. Well, I'm more able to cover my interest bill. This is better, right? I just have more operating income with which to pay my interest. This is better. I'm in a better long-term debt paying situation here. Okay, so that's the so long-term debt. It's better across the board. Not crazy better, but it is better. This company is in a better position to service its debts, and that's a good thing. Let's move over to 12.3a. There's a lot of ratios here. I'm just thinking about how to lay this out to make it fit more nicely. I think I can do that thing where I squish it. Squish you over. I hope it still remains legible. I'm going to zoom in a bit on each of them as we go. So hopefully that kind of covers up for any problems I know I'm causing in terms of legibility and readability. So gross profit percentage, gross profit divided by net sales. That's the formula from the formula sheet. Here we go. Our company's gross profit line is right here. Our net sales line is right here. So 2.1 million divided by 3.6 million. 2024, 2.1 million divided by 3.6 million. And that compares to 2023 when it was 2.3 million divided by 3.9 million. Okay, let's crunch those numbers. 2.1 million divided by 3.6 million. This is our margins, right? This is our markup. We're able to mark up 58% of our sales turn into profit, so gross profit. So 58.3% this year, and last year, let's crunch that number, 2.3 divided by 3.9, 58, basically 59% last year. So, would you rather have 58% margins or 59% margins? Bigger is better. This is marginal, this is minor, but it is better, right? This is a key number, though. Apple will always tout this in their earnings call, their margins, their profit margins. They're always looking for higher markup items. And in this case, we got a little bit worse, didn't we? We are marginally less profitable. Okay, return on sales, net income divided by net sales. Let's see what our company's net income was. We already have net sales highlighted. Net income is the bottom line. This just says every sales dollar, how well are we converting our sales into profits? This year, 215 divided by 3600. Last year, 110 divided by 3.9 million. 215 divided by 3600 is 0.597, 5.97%. Last year, 110 divided by 3900, 2.82%. So again, this is a measure of how well we're converting sales into profits. This year, 6% of every sales dollar becomes a profit dollar. Last year it was about 3% of every sales dollar becomes a profit dollar. You'd rather be more profitable. So this is much bigger. This is much better. The one before, the gross profit percentage, marginally worse, not much worse, marginally worse. The profit number here, much better. Return on sales, much better. So the better here is much more important to me than the worse in the line above. Return on assets, net income plus interest divided by average total assets. Okay, so we've got our net income here. We're going to add in interest. So let's do that just real quick. Net income plus interest, 215 plus 200 is 415. That'll be our numerator. And 110 plus 150 is 260. That'll be our numerator for 2023. Let's fill that in. 415 divided by something, and 260 divided by something over here. Average total assets. Okay, so I've got my total assets here, and I want to take an average of them. So I'm going to average these two for my 2024 average, and for my 2023 average, it's the average of the two on the right. So let's average the two on the left. To average two numbers, add them together, divide by 2. So 1375 plus 1053 equals, divided by 2 equals, the average is 1214. And the year before, 1053 plus 905, average, so divide by 2, and we get 979. Okay, so my denominator here is the average total assets, 1214 and 979. Let's compute the numbers here. Return on assets. This is a measure of how effectively we're using our assets, right? How profitably we're using our assets under our control. So 415 divided by 1214 gives us a return on assets of 34.2%. Means every dollar I've invested in assets is returning me 34 cents of profit. 260 divided by 979. Last year it was 26.6%. So again, bigger is better here. For any of these returns, you would rather see more profits than less. I know I sound like a greedy capitalist here when I talk like this, but it's truthful. If you are putting your assets to work, you would rather see more return than less. That is for sure. All else being equal. Return on equity. Net income minus preferred dividends, and this is return on common shareholders' equity. Net income minus preferred dividends divided by average common shareholders' equity. Okay, so this one's a bit of a mouthful. Net income minus preferred dividends. We got our net income up here. We've highlighted it already. Let me re-highlight that. There's my net income. Preferred dividends. Well, we do have preferred shares. So preferred dividends, what are our preferred dividends? Well, whenever we see a number beside preferred shares, that's their guaranteed dividend, $20, and there's 1,000 shares. So what are my preferred dividends going to be? 20 times 1,000. My preferred dividends are going to be $20,000. So let's, because the net income, the first claim on net income goes to the preferred shareholders, we're going to deduct preferred dividends. So I'll just make a new line here. Net income minus preferred divs. 215 minus 20 is 195, and 110 minus 20 is 90. Again, the preferred dividends are 20,000, and the formula here is net income minus preferred dividends. So it's 195 and 90. So let's put that in as our numerator here, 195, 90, divide by average common shareholders' equity. Okay. So again, this one's a bit of a mouthful. We've got shareholders' equity, total shareholders' equity here of 438, 343, and 260. But each year, 150 belongs to our preferred shareholders. So we got to take that out. Common shareholders' equity is going to be 438 minus 150, or another way of thinking of it is just common shares plus retained earnings is what belongs to our common shareholders. So 100 plus 188, maybe that's the easier way of thinking it. 288K this year. Last year, 193K, and the year before, 110K. Now I need the averages, so I got to average between those. So 288 plus 193 divided by 2 gives us 240,500 for 2024's average. 193 plus 110 divided by 2, 151,500 is our average there. Let's put these numbers in. 240.5K, 151.5K, and we can compute our return on equity here. 195 divided by 240.5 gives us 81.1%. This is extremely high as an ROE, and 90 divided by 151.5 gives us ROE of 59.4. Again, very high, but we would say that bigger is better here, and so certainly our ROE is better in 2024 than in 2023. Okay, next. Earnings per share. This is a headline number. If you ever listen to an earnings call or are interested in corporate earnings, they lead with earnings per share. They tell you what the EPS is. It says for every stock, for every share you own, how many dollars did the company earn you? And it's a good basis for determining stock prices. So net income minus preferred dividends, and that's the same numerator as the last one, so I'm just going to put in the same number. We have it written up here again. It was 215 minus 20, 110 minus 20, so it's 195 and 90 as my numerator. And this can get complicated, by the way. If you take an intermediate or an advanced financial accounting class, you'll see all sorts of different calculations for this fully diluted earnings per share and all sorts of challenges in computing earnings per share. We're doing a simple version. So anyway, our earnings attributable to our common shares are 195 and 90. The number of common shares outstanding, and again, this can get complicated. Here we've simplified it. We've said, if you take a look at the common shares row here, it says 50,000 shares all years. So what's the average number of common shares outstanding? Well, it's 50. 195 divided by 50 and 90 divided by 50. 3.9, $3.90, and this is per share, and 90 divided by 50. $1.80 per share. So if you owned a share of a company and it earned you, again, exact same company's share price, one company earns you $3 per share, $4 per share almost, and one earns you $2 a share, you would rather earn more per share. So bigger is better, and this is no question bigger and better. So when I look at profitability, taking a look at the big picture, this is a good news income statement, right? This is a good news profitability ratio situation. This is significantly better year over year. The only one that was worse was gross profit, and that was marginal. So the profitability of this company is unquestionably better. Okay, one more set of ratios. Stock market performance. So we're interested in the stock market. Price to earnings ratio is a measure of how much the stock market values us. In other words, does it give us good value? So market price per common share divided by earnings per share. Now, our denominator is earnings per share. It's this that we just calculated, EPS, earnings per share. So 3.9 and 1.8, that's our denominator. 3.9 and 1.8. So let's do it for 2024, 2023, and I know the denominator is $3.90 per share and $1.80 per share the year before. Our numerator, market price per common share, it was given in the additional information, 2024, $150, 2023, $50. This is a company that's done well. Its stock price has tripled this year. So let's do the math. 150 divided by 3.9. Come on, calculator. 150 divided by 3.9. 38.46. This is a huge multiple here on earnings per share. 38.46. This means that the stock market thinks we are going to really grow fast. Maybe this is a tech company or something, because most companies don't get this high of a multiple. 50 divided by 1.8. Last year was 27.78. So as a measure here, if you are an owner of this company or you are operating this company, this is a very good sign. It's saying outsiders of the company, the stock market, thinks that we are an attractive investment and getting more attractive. The fact that they're willing to pay a higher multiple of earnings says something that's not captured in the earnings they like. So bigger is better here, and we are doing better. An example of a company like this with really high price to earnings ratio is like Tesla, which is not a very profitable company, but has a high stock price. Amazon for years and years and years reflected this. And it was just something in the market said, we like this company, even though it's not as profitable as the stock price seems to indicate, right? Something else is in the ether here that we like. And that's what's happening here, where our price is outstripping our earnings. This is a good thing, though. If you're running the company or you're involved in the company, you like to see this. If you're thinking of investing, this is a bad thing. It means the stock is highly priced and maybe even overpriced. That's certainly debatable here. And people might debate that about Tesla, and certainly may have debated about Amazon at a time. Okay, dividend yield, dividends per share divided by market price a share. So it's all in this little table. Our market price is 150 this year. Our dividends per share is $2. 150 divided by 2. Have I done this backwards? Yeah, I did this backwards. I was like, this shouldn't be such a big number. 2 is our numerator, dividends per share, divided by the market price of 150. 2 divided by 150 for 2024 gives us dividend yield of 1.33%. Last year, it was 1 divided by 50. That gives us dividend yield last year of 2%. Well, you would rather have a higher dividend yield, all else being equal. You would rather have more dividends. This is worse. Okay, So kind of a mixed bag here for stock market performance. It's going to depend on what you're looking for as an investor. If you're looking for that dividend and cash flow, this stock became a worse investment this year. If you're looking at just stock market returns, this is a very high performing stock. And so I would say overall, I would rate the top ratio as maybe more important than the bottom, but it's going to depend on the investor. So let's kind of go back through this whole thing and just kind of evaluate the company. So stock market performance, my bias says it's better. Again, a dividend investor will tell you it's worse. Profitability, it's just way better. No doubt about that. Long-term debt paying ability, they're doing much better. In terms of internal efficiency and turnover, much worse, significantly worse. And in terms of liquidity, I would argue a little bit better. Even though it's one worse, one better, I think that acid test ratio being higher, much higher, is more important than the current ratio being a little bit lower. So that's my view on this company. You'll find most of the time when you do ratio analysis, it is a mixed bag. You don't just go down the list and go better, 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 worse, 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 worse. There is a mixed bag to be had here. All right, we've come to the end of problem 12.3a. I hope this video has been useful to you. If you've made it, we're over 30 minutes here. If you've made it, write in the comments below that you've made it, because good grief, I don't think many people watched the end. And if you watched the end, I hope you got something out of the video, and I hope you've gotten something out of this video series. I really hope it's helped you. I hope you do well in your accounting studies and in your accounting career. That's all for now. I'll see you soon. Bye for now.